Well, joining me now to talk more about where Wall Street firms are headed is Jim Reynolds, a longtime friend of our show, also the chairman, CEO, and co-founder of Loop Capital Markets, joining us from Chicago. And Jim, you were listening in on the Vikram Pandit interview yesterday, and you said it basically underscores the view that you have that Wall Street firms are going to be able to are not going to be able to rely more and more on capital markets. In fact, it'll be less and less, particularly given the new regulations, right?
Yeah, Betty, it's interesting. I know you and I chatted a bit about it yesterday, and I've had more conversations about this in the last few weeks than anything else with my taxable fixed income group. And it has to do with what's kind of coming out of Dodd-Frank, what this Volcker Rule is starting to look like, and how banks, commercial banks and investment banks and boutique investment banks are going to react to it. So his comments were spot on with kind of where I thought this thing was going.
Right, spot on in the sense that they're not going to be able to rely on the capital markets to make money. So where are they going to make their money?
Well, it's spot on in the sense, Betty, and that's kind of out there. As you and I talked yesterday, when I listened to his comments, I was struck by the fact that he kept really hearkening to getting back to the basics of banking. Getting back to serving clients, helping our global clients grow globally, providing them advice, making loans, doing what banks do. And as you know, the last few years, banks have started to move out aggressively prior to now into the more lucrative areas of private equity, hedge funds, capital markets activities.
Right.
And he now is saying, no, we're getting away from that. When you look at the Volcker Rule, Betty, it really just basically says we're totally getting away from that. We're getting you guys out of prop trading. You're going to have to figure out another way to make money, and it's steering them back to basic banking.
So then what happens then if you've got Goldman Sachs, Morgan Stanley, JP Morgan unable to do prop trading? What happens then, Jim?
Well, it's interesting that you're going to have Neil Kashkari on after me. My own view is that if you're a large asset manager like a PIMCO, a BlackRock, Western Assets, those guys, you're very concerned about having counterparties out there. You're very concerned about an orderly, smooth market in taxable fixed income trading. Betty, you began by saying, you know, what do you think the impact of this is going to be on Wall Street? It's my firm view that, one, Wall Street's going to be a lot smaller in the capital markets businesses, particularly the risk businesses, the trading businesses that use the balance sheet, most notably taxable fixed income trading. They've already shrunk there. And so when you look at what the large asset managers are going to do, they have to be weighing in very, very heavily now to Congress as these rules are kind of germinating there. They're not in final form yet to say, hey, you can't really take these guys out of this business or we're not going to have an orderly market. And that's a very serious issue.
Right, but Jim, whenever somebody leaves a market, there's others to come in, though.
Betty, that's basically true, except the barriers to entry to what we're talking about. I mean, if JP Morgan, Goldman Sachs, Morgan Stanley, and Citibank leave a market, you know, with the balance sheet that they have and their ability to kind of have an orderly flow in the multi-trillion-dollar fixed income trading markets, it's not easy for another entity to come involved. Now, I don't think all four will leave. But when you look at the Volcker Rule, what it doesn't restrict, though, is trading activity of foreign domiciled institutions.
Oh, okay.
So you could see, it doesn't. It says just U.S. And so you could see some of the other entities come in and try to fill that void. But Betty, nobody can trade them like the U.S.-based investment banks.
Jim, moving on from talking about Wall Street, I want to talk about what is going on in Washington. And with all this debate, you know, here we go again. We seem to be back to square one on debating about cutting the deficit. I remember last time when we talked in August, you were saying that S&P made a mistake when they downgraded the sovereign credit rating of the U.S. But do you think since then it has served any purpose in this debate?
Well, it's interesting. I know we talked that Monday after that Friday that they did that, Betty, and I was pretty vehement in my displeasure at their actions, particularly why they did what they did. But they really, I thought, sounded an alarm. Clearly, the market didn't pay much attention to that downgrade, but the message was actually sent to the political leadership in Washington that, hey, That's why we did it, was due to the political discourse that's taking place. I'm hopeful, and I'm a market participant, so I'm not a political prognosticator, but I'm hopeful that we can get an agreement, and this 12-member supercommittee will do what it's charged to do, which is at least come up with $1.2 trillion of cuts by November 23rd, at least that number.
But Jim, do you think even with their dilly-dallying over this, is it going to have as big of an impact on the markets this time around as it did back in the summer?
I'll tell you, Betty, my view on the impact that it's going to have. And I think if they do nothing, it's interesting, when I was in New York last week, I visited with a CEO of a very large global institution. And he said to me, Jim, what do you think the supercommittee is going to do? And I says, what do you think? He says, I think they're going to deadlock. And I said, I hope they don't. The downside to not moving forward with the cuts are, I think, basically threefold, Betty. One is the credibility of this group. This group was put together because that was the only way we were going to move off of that debt limit discussion, period. Two, the credibility of, I think, the U.S. and the leadership of the U.S. is at stake. And three, I think, Betty, just our ability to lead with our actions is really going to be in question here. So it's really hard to say. Lately, though, I've been very encouraged that the Republicans have really backed away from a no new tax posture to we'll look at enhanced revenues through something other than tax increases, which I think is good.
Okay, Jim, great to talk with you, as always. Jim Reynolds of Loop Capital Markets.